Welcome to the complete guide to forex trading for beginners. If you are a complete novice or you don't understand the basics of forex, then this video is for you. First, let me introduce myself. My name is Femi Kodri. I'll be your instructor for this eye-opener beginner course for forex trading. I've been trading for over 6 years now. I started in September 2017 to be precise, and I've been profitable and consistent for roughly 3 years now. Presently, I trade for proprietary firms using company's capital, and we end up sharing profit at the end of every trading cycle. So this is the course outline I'll be using today. I'll first talk about the real life scenario of forex trading. I'll talk about the different market sessions. We have 4 sessions in forex trading. The major currencies, pips, what is lot size, lot in trading, spread. I'll discuss the different types of Forex orders. Then we go to demo trading. As a new beginner, it's advisable you start with demo trading. Then we get ready to place our first trade. We look at the different terminologies in the trading software. Then I go to different types of the market interpretation, talking about the fundamental analysis and technical analysis. Then I'll be rounding up with different market conditions. What is my expectation at the end of this course? I expect you to do further research after this short course. Most importantly, I expect you to ask questions and join the PIPS Lab community where you can share ideas with fellow traders. Then most importantly, you practice. So let's start with the real life scenario of forex trading. Before we start, what is forex? Forex is a global financial market that allows one to trade currencies. If you think one currency will be stronger versus the other and you end up being correct, then you can make a profit. People get on airplane, they travel internationally. If you ever travel to another country, you usually have to find a currency exchange booth at the airport, and you exchange the money you have in your wallet with the currency of the country you are visiting, displaying different exchange rates for different currencies. So what exactly is exchange rate? Exchange rate is the relative price of two currencies from two different countries. As we can see on this screen here, we can see different exchange rates. So this woman here is exchanging our currency at the currency exchange booth. She's exchanging our USD with euros. So let's assume she traveled from the United States to France for a conference. So how does it work? The concept of forex, how people actually make money in forex. Let me show you a blank screen. Okay, so let's assume that the woman, she's exchanging 100 USD with her at the airport, as we saw on the screen. USD, she wants to change her money to euros because she'll be spending 1 week for her conference. But at the day of the exchange, the rate is 1.25. So she will be exchanging 1.25 to 125 euros. But at the end of our conference 1 week, she end up not spending any of this money. But the US dollar, it has weakened. Instead of the initial 1.25, the exchange rate was let's say, for easy calculation, let's say the exchange rate is 1. So what that means is that our 125 euros she got from $100 is now worth 125 USD. So what that means is that she's making a profit of a profit of $25 for just holding the money she exchanged for 1 week. So that's how Forex works. So let's go to the next slide, which is different market sessions. We have 4 market sessions in Forex trading. Forex market is open 24 hours a day for 5 days in a week, only closing during the weekends. Unlike the stock or bond markets, the Forex market does not close at the end of each business day. Instead, trading just shifts to different financial centers around the world. As you can see on this screen here, the market opens with the Sydney session. Sydney session opens almost at the same time with Tokyo. And we can see that Sydney closes while Tokyo continues. Towards the end of Tokyo, the New York session opens. Then midway to New York session, we can see the beginning of New York section. Then almost midway to New York session, that ends London session. Then it continues going where we now have the reopening of Sydney session. So I'm going to show you the real live visualization of how the market section moves. I'll be showing you that on baby pips. So let's go into that. The first thing you do is you go to baby pips website. You type baby pips on your web browser tab, babypips.com. So when you get to the site, you try to locate tools. Then from tools, you go to Forex market hours. You click on it. So it takes you to real live time. So anytime you go to the website and you click on tools, it gives you the exact period where the market session is. For example, presently today is Friday and it's just 5 minutes to 1. So this is showing real life time. So as you can see here, as I mentioned earlier, we have the first section just real life as is happening. So if you look at the lower portion to the left here, you're going to see trading volume is usually high at this time of the day. So what that means is that if you want to trade during the New York session, it's best you trade within this period here. You can see the graph here. The peak is best you trade between 2 and 11. If you want to trade during the London section, the volume is highest during 10 a.m. and time here to 6 p.m. So just play around the tools and understand it better. So moving on, we have 8 major currencies in forex trading. Why are they called major currencies? Why there are potentially lots of currencies you can trade as a new forex trader? You will probably start with the major currencies I have on my screen here. That's these 8 major currencies. They are called major currencies because they are the most heavily traded currencies and they represent some of the world's largest current economies. So these 8 currencies are the major currencies: the US dollar, the euros, the pounds, the Swiss franc, Australian dollar, Canadian dollar, New Zealand dollar, and the Japanese yen. Currency symbols always have 3 letters. As you can see here, they always have 3 letters, where the first 2 letters represent the name of the country and the third letter identifies the name of the currency. Yeah, you usually have to trade a currency versus another. As we have here, this is Euro USD, trading one currency over the other. We have the Great Britain Pounds USD, GBP USD, USD Swiss franc. So you always have to trade a currency over another. So let's go to the next slide. So this is a blank. I'll be illustrating how trading works. Forex trading involves trying to predict which currency will rise or fall versus another. Let's illustrate with Euro USD, for example. Euro USD. In this case, the euro is the base currency, while this is the quote. This is the quote, while this is the base currency. The euro is the base currency for the buy or sell. If you believe that the USD economy will continue to weaken, which is bad for the US dollar, you would have to execute a buy trade. So in this case, if you believe that USD will weaken, that means you have to buy Euro USD. By doing so, you have bought euros with the expectation that it will rise versus the US dollar. But if you believe that the US economy will be strong and the euros will weaken against the US dollar, you would have to execute a sell trade. So if you believe that USD will be stronger than the USD, then this pair you have to sell it. Downward movement of price means sell, while upward movement of price means buy. Let's move to the next slide. So what exactly is pips? Pips. In trading, we talk in pips, which is percentage in profit. Pips is the unit of measurement to express the change in value between two currencies. A pip is usually the last decimal place of price quote. As you can see here, it's usually the last currency of a price quote. Most pairs go to 4 decimal place, as you see here, but there are some exceptions in yens. See the Japanese yen. This one is having all Japanese yen have 2 decimal place, while others have 4 decimal place. But there are forex brokers that quote currency pairs beyond the standard 4 and 2 decimal place. So instead of this 4, some brokers will quote 5 decimal place, as you can see here. But in this case, the fourth value after the decimal place is a pip, while the fifth value after the decimal is the pipette. Most times you have to ignore the pipette. You always count the pip digit. The pip digit is the 4th digit number and the 2nd digit number. So for brokers that have 5 digit number, you must always ignore the last. You always ignore the last and focus on the 4th and the 2nd. So how do you just like we have here, as I mentioned to you, the 4th value is always the pip, that is the unit 1 pip. While most cases you just have to ignore this pipette, that is the 5th value. So how do you count pips? From this value here, it's showing 1.2468. This one is showing 1.2469. So looking at the 4th digit here, 9 and 8, the difference is 1. That is 1 pip. From this one here, looking at the 4th digit, starting with the 4th, you can see that the 4th digit here, we have 8 and 8. We have 6 and 7. So movement, subtracting these two, ignoring the last. This last is not necessary, just leave it, the pipette figure. So this one is showing a difference of 10 pips. This one, if you subtract this from this, is showing 100 pips, while this from this is showing 10 pips. So that's how you calculate pips, because in forex you make your money in pips. Pips means dollar, means whichever currency you are trading on, maybe your Australian dollar, Canadian dollar, but your pips is equals to money. Let's move to the next slide. Forex is commonly traded in amounts called lots, or basically the number of currency units you will buy or sell. A lot is a unit measuring a transaction amount. When you place orders on your trading platform, orders are placed in size quoted in lots. I'll be showing you this on empty for later. It's like saying, it's like, let's say you like crate of egg. When you buy a crate of egg, you usually buy a carton. One carton includes 12 eggs. So in this case, relating this to egg carton, a standard size for a lot is 100,000 units of currencies. We have the mini, the micro, the nano sizes. As we can see here, the standard is 100,000, which is equivalent to one volume. So one pip to a dollar using this volume is $10. One pip to a dollar using this volume is one. $1 to a pip is using this volume is 0.1. So the higher the volume, the more money it is equivalently. So if you are trading a large account, it's advisable you gauge your volume. That's your lot size. I'll be showing you this when we go to the demo trading session. Moving on. So what exactly is spread? Forex brokers will quote you two different price for the currency pair. The first one is the bid, while the second one is the ask. The bid is the price at which you can sell the base currency. In this case, is the price you can sell this euro USD, euro being the base currency. While the ask is the price at which you can buy the base currency. So you can buy at this price, you can sell at this price. Most brokers, as I said earlier, will always quote two prices. I'm going to show you that on TradingView and then on MetaTrader 4, which are the two trading software I'll be showing. So the difference between these two prices is what is called spread. The difference between the bid and the ask is spread. So in this case, the difference is 6 pipettes. Remember I told you pipette is the fifth digit after the decimal place, 1, 2, 3, 4, 5. So this is pipette. So this is very small. The price at which you buy or willing to buy, price at which sellers are willing to sell. So the difference, as I said earlier. So that is what spread is all about. Into order now, there are different orders in Forex. Orders fall into two buckets generally. Market order are orders instantly executed against a price that your broker has provided you. Why we have the pending orders, which are the orders to be executed at a later time. So let me explain this to you. When you open your MetaTrader software, I'm going to show you how to go about this later on this lecture. You have to read, then you enter the volume. As I said earlier, some brokers will name this volume as lots. So after doing that, you place a value you want to your trade to stop out, the take profit. I'm going to explain that to you. As I said just earlier, there are two types of orders, the direct execution and the pending order. So assuming you want to enter the trade instantly, you can click a buy or a sell. But if you want the order to be placed at a later time, you can click on pending order. So by the time you pick this pending order, it takes you to this list here. There are different types of pending orders. It is later that you just exactly as you see it here. That's how you are going to see it anytime you click on pending order on your MetaTrader 4. So we have the limit orders and the stop orders. So let me just explain to you how this works. So this is a buy limit. These are the limit orders, the buy and sell, and these are the stop orders. The order to buy at or below at a specific price. So let's assume the current price is here because trade as in market moves in waves. So assuming the current price is here and you want to wait, you don't want to buy present time, you want to buy at a lower price, that means you are placing a buy limit. So once the price gets to this level, your buy trade will be executed. So conversely, if you want to sell a price but you want to wait, you don't want to sell at the current price, you want the price to get up a bit before you sell, that is sell order. Buy stop, assuming the current price, you don't want to buy at the current price, you want to buy at a higher price, you set your buy stop. So once your price gets to the level you want, then the buy will be executed. And also for a sell trade, you don't want to buy at the current, you don't want to sell at the current price. You want to sell at a lower price. Then you place your sell trade at the price you want. So once the price gets to that place, your sell will be executed. So that's how, this is just a graphical representation of the different market orders we have in Forex. Let us now discuss how you can start demo trading, demoing your way to success. You can open a demo account for free on most Forex brokers. These simulated accounts have most of the capabilities of a real account. So you ask yourself, why is it free? It's free because the brokers want you to learn the ins and outs of that trading platform and so that you have a good time trading without risk. This way you'll fall in love with them and eventually deposit your real money. The demo account allows you to learn about the mechanics of forex trading and testing your trading skills with process of zero risk. So the first thing you do is you go to your Play Store, and if it's iPhone, you can also download it on your iPhone, but I'm using Android for this class. So you just go to your Play Store, it's just like I have on my screen here. You type in MetaTrader. I use MetaTrader 4 to trade. You can as well decide to download MetaTrader 4, whichever your preferences, you select it. So I go for MetaTrader 4, after which I wait for some seconds for it to be installed. After installation, you just click on install here. Then next thing is you open the app, which takes you to their terms and conditions. You just click on accept. Then the next thing is you get to see the interface of MetaTrader 4. Remember I told you the brokers always quote two prices for you. So this is what I mean. Then they have to quote you the hacks and the bid price. So here is the hacks price and here is the bid price. Remember that the difference between this and this is the spread. So the spread for each brokers varies, but the lower the spread, the better for you as a trader. So when I install this app, automatically the platform, the MetaTrader 4 automatically opens 100,000 USD accounts for you to trade on, to practice on. So let's assume that you have your own login details. You can as well just come here, you log in existing account details here, or let's say you want to open another fresh demo account if you don't want to use the $100 account. Although most times I will advise people to start with low amount so you can have the full impression as if you are dealing with your exact money, so you know how to control your emotion perfectly. So let's assume you want to open another demo account. You just click on open demo account here. Then this space here, you type in the name of your broker. We have so many brokers. I'm going to discuss the brokers we have on another video. So here you type, is either you type in the broker you want to use, or you just click on Meta Quotes Demo to create your demo account. So that takes you to your personal information. You enter your name, your phone number, your email, then the account type. Most people use the USD account. You can as well choose AUD or CAD, that is Canadian dollar or Australian dollar, any currency type you want to choose. Also, you choose the leverage you want. I'm going to discuss leverage in the subsequent slide. Very soon I'll discuss that. Then you pick the amount you want to trade with here. When you are done, you click on create account, which takes you to the details of your account. Your name, the account type you selected, your deposit amount, your login details, password, and investor password. This investor password is if you want to show people your trading performance without having direct access to your account, then you can give them this investor password and you click on done. So here is the account we just opened, the $100,000 account, as you can see on my screen here. Then if you want to place a trade, you can come here to these three dotted lines here. You click on it. You long press on the pair you want to trade and you select, you enter your details. Remember I discussed the instant execution and the pending orders. So if you want to enter your trade directly, you just click on this instant execution. You enter the volume, your lot, as I explained in the previous video. Then this is your ask price. This is the bid. You enter your details, your stop loss, depending on the direction of the market you want to enter, and your TP. So assuming I want to enter a sell trade. For this example now, I'm entering a buy trade. That means the price I'm entering, once the price goes down, then that means it's moving against my direction. So the stop loss should be lower than the figure I'm entering the trade. As you can see here, I entered 1.06. I'm going to illustrate that with you later on trading view. Then the take profit should be higher than the figure we are entering the price here. You can see I have 1.1, while the entering price is 1.071. Then you click on buy. So immediately you click on buy, it takes you to your dashboard, your trading dashboard. Then you get to see different names here. Yeah, this is the trade I just placed here. Euro US, as you can see here, Euro US, this is the price here. Then if you want to see the details of the trade you entered, or you want to modify it, you just click on the trade, then to bring out all the details. As you can see here, my stop loss, my details, my TP, and this swap is if you held your trade to the next day. So let me explain to you what we mean, the meaning of all what we have here: the equity, the free margin, the margin level, and the margin here. For the account balance is just simply the starting balance of your account. Basically, is the amount of cash you have in your account. The equity is the current value of the account, and this usually fluctuates every tick when looking at your trading platform on your screen. The equity is the sum of your balance and the floating, which is the unrealized profit or loss associated with your account. As you can see here, is floating here is $570. You can see 100,000 $570. So this is just my floating profit. It keeps fluctuating. So the price, the unrealized amount is your equity, while the start yield, the amount you have in your account, is the account balance. So the trade keeps rise and fall, which varies, and this does the same way with your equity. The free margin now can be thought in two ways. Is the amount available to open positions. The amount is also the amount that existing provisions can move against you before you receive a margin call or stop out. So the margin level, which is represented in percentage, is value which is based on the amount of equity versus your used margin. This allows you to know how much of your funds are available for you to trade. The higher your margin level, and the higher your margin level, the more free margin you have available for you to trade. While the lower your margin level, the less free margin available for you to trade. So what is your margin? Your margin, when you're trading forex, you are only required to put up a small amount of your capital to open and maintain a new position. So this capital left for you to open your position is what is called your margin, which is simply a portion of your funds that your broker has set aside from your account balance to keep your trade open and to ensure that you can cover the potential loss of your trade. For now, leverage is not showing here, but for the leverage, which will appear anytime you want to open an account, you see different figures on your leverage. The leverage actually allows you to trade the positions that are larger than the amount of money in your trading account. For this account, I choose 1 to 100. 1 to 100. Leverage 1 to 100. The leverage is usually in 1 to ratio X. It could be 1 to 2, 1 to 5, 1 to 50, depending on anyone that suits you. But for professional traders that have years of experience, we prefer to go for a lower leverage, let's say like 1 to 5, 1 to 10, because that way you'll be able to preserve your capital more. But the downside to it is that you won't be able to make so much in a short period of time. But if you choose a very high leverage like 1 to 200, 1 to 100, that means with your small account, you can make so much money. As at the same time, you can easily blow your account with a very high leverage. You can start with high leverage, but as time goes on, you'll get to realize the importance of using a small leverage. Now let's go to the next types of market interpretation. In trading, we have different forms of analysis. We have the fundamental analysis and the technical analysis. So fundamental analysis is a way of looking at the forex market by you analyzing the economic of the country, the social and political forces that affect the currency price. You have to understand the reason why and how certain events like increase in unemployment rates, how the country's economy is performing, the monetary policy, which ultimately will affect the level of demand for the currency you are studying. The idea behind this type of analysis, that the fundamental analysis, is that if a country's current or future economic outlook is good, that means the currency will strengthen. In this case, assuming we are looking at Euro USD, so if the economy is good, if the economy of USD is good, that means Euro USD will be selling. So at that time, at that period, you will be looking at selling opportunity. Technical analysis. I'm a technical analyst. So technical analysis is the framework in which traders study price movement. But before going to technical analysis, let me just show you the most common, the most used website where fundamental analysis check for to know events happening worldwide, which is called the Forex Factory. So let me just go to Forex Factory and show you. You type in www.forexfactory. You go to the website. There on the website, you're going to see different events happening for the week. As you can see here, this week, January 14th to January 20th. So all the events, all the fundamental analysis all the fundamental events that is going to affect the trading for the week is listed here. Although we have other websites whereby you can check for the for news event that impact the price movement, but the most common website is the Forex Factory. So as you can see here, if you want to check the coming week, you just click on this arrow here. It will take you to the next trading week. So let's go back to the current week. So on the left side here, you can see the date, you can see the time. At this present time here, you can see that all these parts are not being highlighted. That means for this week, all these news events for this week, it has already happened. All this has all is now a past news. So presently now, for this week, the remaining news event for this week is just the news that is coming up at 3:30 p.m. because today is Friday. We are almost rounding up for the week. Then you clicking on this place, you are going to see the calendar for news events. You can just come and pick the date, whichever date you want to look at. You pick it here. So it's advisable as a fundamental trader, if you want to trade, always be conversant with the news that is going to be coming up, so you won't be caught unaware. So here we can see the currency here. If you want to trade any pair that has an JPY in it, you have to be careful during any hour you have a news pertaining to a currency. You are going to see that after the list of currencies here, we have different colors of folders. You can see yellow, you can see brown, you can see red. So this yellow is simply means that this news here have very low impact. The impact of this news on the market is not strong enough. For those showing brown and brown color, that means the news event is medium. It can be high, it can be low, it is medium. While the one showing white here means neutral. So this event there, it means that all day long USD US dollar bank, that means United States Bank are on holidays. Then you can see here red. So what this means is that for this week, this week I'm looking at here, the first high impact news is on Tuesday, that is the 6th of January. This red here, the note high, as you can see here, it's coming out. The note high impact news. That means any impact for pairs that has a GPP on it. So you can just see a high spike in price during this period. So if you want to trade, you have to be aware that Tuesday around 6 a.m. around 8 a.m. here, there might be rapid change of price level. Then another folder here that is showing red is a Canadian dollar, which is around 2 p.m. here. So for the remainder of this week I'm looking at, so before the close of trading for this week, if you are a fundamental trader, that means the present time is 3:25 p.m. as you can see here. So I should be, if I'll be trading, or if I'm a fundamental trader, that means in another 35 minutes I will be very careful of any pair that have USD in it. So you can just play around the website, but you can see that the news here has so much, mostly yellow folders, but you can filter the folders here whereby you will be able to see only the high impact or the medium impact news, because most times all this yellow impact doesn't have any effect on your trading or your candle chart. So here you can come and filter here. Once you click on filter, it brings out the all different folders. So what I do usually is I only mark red and the brown folder. I will uncheck this and this, so it's going to bring out only the red and brown folder news. So let's click on apply filter. So we can see that the list of news is now minimal. That means we can actually see the news that is going to impact the market more for the week. As you can see here, for Monday, we usually have only two brown folders. For Tuesday, you can see we have mixture of brown and red. Then Wednesday, you can see. So it's better you filter and stick to the brown and red folder news. So just a brief about forest forest factory. We have so many things on here. I might do another video on in-depth knowledge on forest factory because there's a lot you can gain on this forest factory. You can see here trades, forum, then the calendar, market, and all the rest. So that's just a brief intro to forest factory. So let's go to the next slide. So coming back to technical analysis, which is the framework in which traders study price movements. So the theory is that a person can look at historical price movements and determine the current trading conditions and potential price movements. So technical analysts look for similar patterns that are formed in the past and will form a trading around their idea, believing that there is a possibility that the same thing will happen. So I'm going to show you some, maybe in subsequent videos, how to use all the different kinds of trading tools, the trend line, the horizontal, the vertical lines, the Fibonacci, the channel tools, and the rest. So going to chart now. Charts. What is chart? Chart, or specifically we call it price chart. This happens to be the first tool that every trader using technical analysis needs to study. So you need to study how chart works. Chart is just simply a visual representation of currency pairs over a set period of time. So I'll be showing you this on TradingView. So what you do is you go to tradingview.com. I have it already on my system. TradingView, then you go to charts. So this is just the graphical representation of price movement. These are charts. So this is my preferred setting. This I've done some analysis on my chart here. Let me just explain how it works to you. On the far right left here, you can see the tools, different tools for you to draw to make your technical analysis. I've done my own analysis here for Euro USD. If you come here, if you click here, you can type any pair you want to trade. As you can see here, Euro USD, I have so many listed Euro USD here. What this means is that different brokers are offering this Euro USD. So you just click on your preferred broker, but it's the chart, the movement is very similar. But why I preferred FXCM is that it shows more history. What do I mean by it shows more history? Let me click on. This is FXCM broker. Let me go to monthly chart, monthly time frame. You can see here, you can see that there is charts as far back as 1971 for FXCM. Now let's check another broker. Let's check Wanda. For the same chart, for the same Euro USD monthly time frame, you can see that this one started later. This is around let's say this is 2002. You can see that the former, that is the FXM I showed you, shows more history. So that's why I prefer FXCM broker for my charting, for my technical analysis on TradingView. So once you click here and type for any pair you want. Let's try another one. Let's say I want to trade GPP USD. GPP USD. You can see here that everything is listed here. So you just select. We have Forex, we have stocks, funds, futures, indices. Anything you want to trade is on trading view. Anything you want to trade. But our focus is on Forex. So that is it about here. Then for this side, you can see that we have different time. Clicking on the arrow here. The reason why this one is only showing for me is that because I have favorite it. Anything you favorite will come to the top of your toolbar. Let me favorite 45 minutes. You can see that I can see for 45 minutes. So any time frame you prefer, 1 minute, you can see. Any time frame you want to go to very fast without having to scroll up and down, we just favorite it here. You see, once I on favorite it, you can see that it's out of here. You can see that that's gone away. Then before I go back to the PowerPoint presentation, I'm going to mention there that we have different types of charts, but the most common of all the charts is the bars, the candles, and the line charts. So I've already favorite the three here. That's how I have it here. So all these movements is called candlestick. I'm still going to explain the anatomy of candlestick in the PowerPoint presentation. So this is candlestick representation, but you'll notice that this is way easier to analyze. But if you want to see edges, points where you can draw your support line, resistance line, I will discuss that in another video. That's part of the technical terms. If you want to see the edges so you'll be able to draw your lines well, this one is preferred. That's the line chart. The line chart is preferred. So this is showing the bars. That's the bar chart. But this one is very difficult to interpret. That's why most people stick to the candlestick. This one is easier. So depending on the time frame you want to trade on, for this one I'm on presently here, you can see that each stick, each bar represents weekly. So here is 1 week. So for this present week we are in presently, this week, this is all what that happens this week. This is it here. So for every stick is 1 week. So if you go to monthly, for every stick, for every bar is monthly. So any time frame you click represents what is happening at that period. So as you can see here, this is just showing 4 hours. So for every stick that happens here, this one it took 4 hours, 4 hours, 4 hours. So you can just go to any time frame you prefer, 1 hour. So this means every stick here is 1 hour, 1 hour, 1 hour, 1 hour. So that's it. For me as a swing trader, I prefer to work on the higher time frame. So this is daily time frame. So this is all that each bar represents a day. This is all that happens for today presently. And if you look at the right hand side of your chart, you are going to see some time in there. So as this one is showing 6 hours 16 minutes 13 seconds, that means it remains 6 hours 16 minutes 07 seconds for another daily candle to surface. Let me go to the hourly to explain this better. So yeah, it means that each candle is daily. Then the time beside it here means that the countdown here is 15 minutes 46 seconds. So in the next 15 minutes 1 seconds, another hourly candlestick will surface. So you always see the countdown here. This y-axis here, this vertical axis here represents the exchange rate, the price value, as we mentioned in our previous slide. So here you can see that the price here is 1 point. Okay, let me just draw a circle here. Here now is represent a price here. So from here to here, if price move from here to here, that means if we calculate from here to here, it will be how many pips? That will be about 10 pips. So movement from here to here is 10 pips. That is 1.09110 minus 1.0920. From here to here is 10 pips. So that's how it works. You can refer to the previous video on how to calculate pips. So here represents the days. Let me go to the daily time frame. Represent time. This space represent time. This space represent price. So the x-axis is days. This one is price. Days time. This one is price. So September. This is what happened September, October, November. So presently we are in January. I can see putting my cursor here is showing the exact day. Today is 19th of January 2024. So just putting your cursor there, you are going to see the date, the time, everything. You are going to see there. Then another thing to notice, you are going to see some figures here. There's some figure here. I'm going to discuss that in the next slide. This figure here, you can see OHLC. What that means is that O means open, H means high, L means low, C means close. So I'm going to explain that in this next slide. So let's move into that now. This is showing bar charts. Bar chart and candlestick are very similar, as we can see here. But this candlestick is the most preferred because it's easier to understand. You can see that we are having almost the same explanation. We have the high, open, close, low, just as the case of candlestick. But here, there's nobody here, which makes this one to be hard to visualize. But the body here makes visualization easy. So what this connotes is that when price opens, it goes down to the lowest. This is the low. Then as trading session progresses, it moves up to the highest level. This high is the highest level. Then it comes down a bit where it closes for that trade section, depending on time frame we are looking at. So this close. So what this one is illustrating is that it opens here and closes here. We are using a green color to explain this, but in actual fact, you can use any color you prefer. You can, for me personally, for this case, I use white color for bullish. This is what we call bullish candle that is moving up. But in the case of coming down here, I'm using red here, but personally, depending on any color you want to use, it can be blue, black. I use black. So in this case, market open at this point here, it moves. This shows the highest level it moves, and it comes down to the lowest level before it closes at this place. So in this case, the close is below while the open is high. But in this case, the open is below while the close is high. So this is just showing the visual representation of price movements. Now, talking about different market conditions, is whether we have a uptrend, a downtrend, or sideways movement, that is consolidation. For For uptrend, I'll be illustrating that on trading view. That is, if we have something like this, a wave movement like this. In this case, you can see a low here, another low here, another low here. Then here we saw high, we saw another high, then another high. So what we notice that after this low, you have a high. I have another low which is lower, which is higher than the previous low. So in this case, we have a higher low. You can see that this high is higher than this one. So that is higher high. You can see now this one is higher. So in this connotation, the explanation is low high, higher low, higher high, higher low, higher high. So that is how uptrend is. Why the reverse is the case of a downtrend. High, low, high, low, high, low. You can see that the high here is getting lower. The high is getting lower, while this low is getting lower as well. So in this case, we have the high, low, the higher low, lower low, higher low, lower low. So that's how downtrend is, and this is how uptrend is. But in case of consolidation, sideways movements, this is how price moves sideways, moving from one edge to another, one edge to another, one edge to another. All right, so let's go back to our trading view to illustrate the different market condition. So if you want to know the bigger picture, if you want to know the trade you are presently in, if the market is ranging or up trade or down trade, you have to go to the highest time frame. In this case, I'm on the monthly time frame. So from what we have here, to illustrate a side movement, the consolidation movement, you can see this side here. This is what consolidation movement looks like. You can see the edges, 1, 2, 3, another edge here. So in order to understand it better, you can just use the rectangle tool to illustrate it. You can see here, this is what we called the sideways movement. So for the trend, you can see here, this is what uptrend looks like. This is sideways movement, while this is uptrend. How do we know the uptrend? You have to count the waves. So this is what I mean by the waves. You can see that this is an uptrend. We have a low here, we have a high, we have a low, we have a high, we have a low, and we have a high. So one thing we need to understand here is that counting the wave, this is one low, this is one high. Now you can see that this low is higher than the previous low. So this is higher low, while this one is higher than the previous high. So this is higher high. This is higher low, higher high. So that's how you count the moves. So if you want to enter a trade in this condition, all you have to do is you wait for a pullback so that you can continue the up movement. So how do you know if there's a change in market direction? You have to draw a trend line. So once the candlestick breaks the major trend, that means there is a reversal in price movements. So let me illustrate what a downtrend looks like. So let me just this movement, this price movement, this condition, it can be on any time frame. Let me use the daily time frame now. So as you can see on my chart here, at this current moment, there's a sideways movement of price on the daily time frame. You can see here, this movement started 14th of December. Why until this day, that is after more than a month, is still moving on a sideways. So as an experienced trader, the best thing is to stay out of the market during this period. So once there is a breakout from the channel, from the sideways movement, from the consolidation, then you look for a trade opportunity. So how do you know a downward move? How does a downward movement, downtrend looks like? From here we can see high from the high, low, high, low. Then what do we notice here? We can notice another sideways movement. This is another consolidation here. This is a consolidation here. You can see a sideways movement. You use a rectangular tool to demarcate that. So you just draw the edges together. At least you pick two edges. One, two, one, two. You can see this sideways movement. Then there is a breakout from this consolidation, a retest. So as an experienced trader, this is where you enter a sell trade. So if you want to know your risk to reward, just use this risk to reward tool. So assuming our entry is here, so our stop loss will be above this sideways channel. So this price actually move a 1 to 2 risk to reward. So if you are risking 1%, you gain 2%. If you are risking 2, you gain 4. You risk 3, you gain 6. I'm going to prepare another separate video on how to calculate your risk reward, how to calculate your entry and exit. So let's continue. You can see a downward movement. As you can see, then we have a sideways movement here, a breakout. Then you can see on trend. So from here, if we draw our trend line here, as I mentioned earlier, once there is a breakout from the trend line, that means there's a change in price direction. As you can see here, so once there's a breakout from this channel, then there's a change in direction. You can see here from down trend, consolidation, this sideways movement, sideways, then a breakout of the channel, retest, then up. So that is just an overview of how to know the present market condition. You can do that on any pair. So that is it for the beginners course for forex trading. So please guys, kindly like, share this video and turn on the post notification bell so that we can grow this channel together. By doing so, a lot more people will be able to see this video and benefit from it. Thank you so much for your time and see you in the next video.